Hello, everybody. Welcome to Intermediate Accounting, 17th edition. This is by Wiley. This is my problem solution walkthrough for problem 14.6. This textbook, Intermediate Accounting, 17th edition, by the authors are Don Kiso, Jerry Weingett, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by myself, Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so we're going over here now to problem 14-6. Hopefully this won't be the hour-long presentation that my problem 14.5 was. But you never know what'll happen. The good news is we're not going to have to use present value tables because we're amortizing the premium or discount straight line. Okay, so issuance of bonds between interest dates, straight line redemption. Presented below are selected transactions on the books of Simonson Corporation. So bonds payable with a par value of $900,000, which are dated January 1st, 2020, are sold at 106 plus accrued interest. They are coupon bonds, bear interest at 12%, payable annually at January 1st, and mature on January 1st, 2030. So these are going to have, this is a 10-year term. Okay, and it says use interest expense account for accrued interest. I'm not going to do that. I'm going to show you what I'm going to do instead. And we're asked to prepare journal entries for the transactions above. So on 5/1/20, okay, so we're issuing a bond basically for $900,000. Okay. Now they're sold at 106. So we're going to get cash of $954,000. That's just for the bond. Okay. Now, but it's also plus accrued interest. So the amount of the accrued interest is going to be 900,000 is going to be my face value of my bond, my interest rate, which is always an annual rate. So my annual interest is going to be $108,000. Okay, that looks right. However, we're selling these on May 1st. So what do? Okay, so the accrued interest. So at the end of the year or January 1st, the following year, it's going to pay out 108. But since this investor is buying it mid-year, what we're doing here is we have January, February, March, and then we have April. So we're going to multiply this by 4/12, or the interest that has already passed, because on January 1st of 2021, we're going to be giving them 108,000, which doesn't really seem fair because it's May 1st. So they're giving us an advance for the accrued interest. So the accrued interest is going to be 108,000 times 4/12 or 36,000. So we're going to call this cash for the bond issuance, and this is going to be cash for the accrued interest. When you look at the solution in the textbook, the solution in the textbook is basically showing the, how would I put it? The solution in the textbook is going through and showing that they're showing the full amount of 990,000. So over here, now in terms of what they're asking you to do is to credit interest expense, but I don't think that that's really correct, because what we should be crediting is interest payable. And this is going to be for the 36,000. It's a liability we've received in advance that we're going to ultimately be paying back. The difference over here is going to be the 54,000, which is going to be the premium on bonds payable. So it was issued at 106, meaning 6% above the face value. So the premium amount is going to be over here for 54,000. Okay, so this is to record bond issuance on 5/1/20. Okay, We now get over here to December 31st. Adjusting entries are made to record the accrued interest on the bonds and the amortization of the proper amount of the premium. Okay, so 12/31/20. Whenever I pay interest expense on a premium situation, let's kind of remind ourselves of what we have to go through and do. Well, over here, I have a premium on, or my bond payable. My bond payable is at 900,000. At the same time, I have a premium on bond payable. And this was for 54,000. And these are both on 5/1/20. Okay. So what my goal is when I'm dealing with this particular situation, hold on. When I'm dealing with this particular situation, what I want to go through and do is I want to have a bond. Okay. So when I'm writing the journal entry to record interest expense, I'm going to debit interest expense. I'm going to credit cash, but I'm also going to credit the premium on bonds payable. So this is where this one question gets to be a little bit trickier. Okay, so over here, so when I look at this premium on bonds payable, the premium on bonds payable, so this bond is going to be, the bond was issued on 5/1/20, bond matures on 1/1/30, right? So it's a 10-year bond. But in this case, the bond was not outstanding for 4 of the months. So the total months that the bond will be outstanding is going to be 9 years times 12 months per year. Plus, we're going to have 8 months from May through December of 2020. So the total months the bond is outstanding is going to be 116. Now, this becomes really important because when I come over here to amortize my premium on bonds payable, I need to know, well, what is my monthly, what's going to be the monthly amount I amortize this by? So over here, my premium on bond payable was 54,000. The months the bond is outstanding is 116. So my monthly premium amortization is going to be 466 or 465.52. So the amount of cash, or actually, and we're not even paying cash, I'm just going to call this interest payable. So over here, my premium on bonds payable, this is going to be 465.52 times 8 months, or from May 1st through 12/31/20. Now, in terms of the interest payable, right, I've already recorded 36,000. So interest for the entire year is 108. So the amount I'm going to be recording is going to be 8/12, or times 8/12, or 72,000. And this again is going to be May 1st through December 31st. Now, when I'm straight line, when I'm amortizing my discount or premium straight line, the interest expense becomes a balancing entry. When I was doing it on the effective interest method, it's the primary entry followed by the premium. So over here, my interest expense is 68,276 to record interest expense. Okay. Okay, so now once I've gone through and I've done this part over here, So what I'm now ready to do is on 1/1/21, I'm actually paying out the interest. So I'm going to go over here. I'm going to credit cash for 108,000, right? What is that coming from? It's basically my two interest payables are 36,000 plus 72,000, or giving me a total of 108,000. And all I'm going to do here is I'm just going to debit interest payable for 108,000. I don't record any interest expense because I've already accrued that interest expense through the past year. Now, if you looked at the textbook solutions, they have you do some kind of crazy stuff. So, but we're just going to kind of avoid that. Okay, so bonds with a par value of 360,000 are called at 102 plus accrued interest and redeemed. The bond premium is to be amortized only at the end of each year. I don't know what that means, but what I do know is, given my past redemption problems or my past redemption issues, again, it took me 3 tries to get problem 14.2 down, but I'm going to follow the same kind of path what I've done before. So after I redeem this premium, or actually after I have this premium on bonds payable, this over here is 3724.14. So my ending balance is over here of 50,276. This is going to be the balance on 12/31/20. So what I now want to do, because I'm redeeming part of these bonds, is I'm going to split this up into 2 different T accounts. What I'm going to do is I'm going to show my bond payable that I'm redeeming. And this is going to be 360,000. Then I'm going to show my bond payable non-redeeming. And this is going to be the difference between 900,000 and 360,000, or 540,000. Again, I'm still keeping the liability intact. I'm just splitting it up. Now, in terms of percentages, okay, so over here, you've got total of 900,000 as a percentage of the total. This is 40% and this is 60%. Okay, so when it comes to the premium on bond payable, okay, so right over here, this is going to be 50,276 times 40%. This is going to be 50,276 times 60%. Okay, and what I want to make sure that these do add up is that these do add up to the 50,276, and that these add up over here to the 900,000. And we can just put on dates right over here, 12/31/20. Okay, so now we've split it up. We've kept them separated. So the bonds with a par value of 360,000 are called at 102 plus accrued interest and redeemed. The bond premium is to be amortized only at the end of each year. Well, I don't really care about that. What I'm more worried about is that when I do a bond redemption, we've kept them separated. We've separated the redeemed from the not redeemed. So over here, we're going to do a little Red Dead Redemption. I just couldn't hold back on that one. So they're called at 102 plus accrued interest. So let's figure out the accrued interest first. So on 4/1/20, or excuse me, 4/1/21, my bond payable is at 360,000. Okay, my interest rate is at 12%. Okay, so the bond has a stated interest rate of 12%. So the cash paid, or basically my annual cash payment, is going to be 360 times 12%, or 43,200. However, the bond is only outstanding for 3 months, or January, February, and March, right? April's the first. We're not fooling today. Oh God, it's getting worse. So right over here, so my cash paid for accrued interest is going to be 43,200 times 1/3 or 14,400. Okay, so I'm going to credit cash for 14,400. What I'm also going to be doing over here, though, too, is that I've got to record my premium amount. So the premium amount over here is that if this was the monthly premium for all of the bonds, then for this one over here, since we've allocated over 40%, my premium on bond payable is going to be 465.52 times 3 times 40%. And this is going to give me 558.62. So if we take 465.52, which was the premium monthly before the split up, I multiply this over here by a total of, say it is, what is it going to be? This is going to be 40% because that's what I allocated. And then I multiply this over here because this is 360 divided by 900. And I multiply this by basically I multiply this by 3 because this is January, February, and March. I should get to this amount. So again, this is going to be, basically this is a monthly amount. So this is going to be 465.52 times 40%, because remember we allocated over 40%, and then we're multiplying it by 3 because we have 3 months. So my interest expense is going to be recorded at $13,841.38. Okay, so now that we've gone through and done this part over here, we're ready to go through and handle the redemption. So if I come over here, when I do the redemption, I'm going to go ahead and do my final amortization. And what I'm going to do over here now is I'm going to say, okay, what do I have left? So I have left over here $19,552. When I redeem the bond payable on April 1st, 2021, I have to take the bond payable off of my books. So this is going to be $360,000. I also have to remove the premium on bond payable and take that off my books as well, or $19,552. Because these are both now going to be going down to 0. Okay, so now the big question is, how much should I pay to get rid of these bonds? Well, it tells me I called it 102. So the amount that I'm paying for the bonds is going to be 360,000 times 1.02, or 367,200. Okay, so right over here, I look at this and I've got 379, 367, 200. So over here, I'm going to have a gain on redemption of bonds payable. If you have a question why this is a gain, just kind of think about it. This bond had a carrying value on my books for 379,000. But I only had to pay 367 to settle it. So this is going to be a gain on a redemption of bonds payable. Okay. So that's what we've gone through and done for this particular question. Okay. And do we equal up? Yes. Perfect. Okay. So this is to record bond redemption. Okay, so what we're going to do now And if you look at what happened over here is that the book basically combined these two journal entries together. You know, I don't for myself. Actually, there's one thing I want to check here. So I've got 360,000. This is at 12%. So my annual cash payment is going to be 43.2. Oh, I screwed this up. This should be 1/4. This should be 3/12. Wow. Okay, so it's really not going to change. My premium amortization isn't really different. But over here, my cash paid for interest is going to be 10,800. Okay, so my cash paid for interest is 10,800. So again, I screwed up on this part right over here in terms of the amount. I'm not going to redo the video. Rather, we'll just kind of roll with it. So let's see if this has changed really anything. I don't really think it did. No, it didn't. 79,552. Yeah, we're fine. Okay. So because the premium, the interest expense is essentially being driven by the amount of the premium amortization that we did do correctly. Okay. Okay. Now, for this last one over here is on adjusting entries to record the accrued interest, the amount and the proper amount of the premium amortized. So on 12/31/21, we're now going to go through and record the amount of, we're going to accrue for the amount of the unredeemed bond. So I'm going to have interest expense. I'm going to have interest payable. My interest payable is going to be 540,000 at 12%, or 64,800. Right, this is going to be my interest payable, or 540,000 at 12%. Okay, so my premium on bonds payable, well, what is this going to be? Well, if I take my monthly premium amount, I multiply that by 0.6, because remember, we did not redeem 60% of the bonds. I multiply that by 12, I get 3,351.72. So the amount of my interest expense is going to be 61,448. And let's see. Okay. I'm coming at the question. The book is doing a couple different things over here, but these numbers are correct. So we've got over here, we've got interest expense, interest payable, and this is basically for the unredeemed amounts. Okay, so let's go ahead and take a quick look back on this question. So we're doing problem 14-6. So we did the initial bond issuance. Now here's my first divergence. So I credited interest payable because they said to do it to interest expense, but I don't think that's really right, because I'm getting cash in advance that I'm going to eventually have to pay back. But maybe they're calling it this, maybe call it another payable, because it's not necessarily interest or customer advance, or advance from customer, but something like that. So right over here, or maybe interest advance payable might be better. So when I accrue for it, my interest expense is going to be reflecting the amount of time that I had the bond out for. So my interest payable is 72,000 for this last part of the year, because I've already accrued for 36. Remember, the total amount I'm paying is 108. So I took 465.52, which was my monthly premium amortization. For the monthly premium amortization, remember we're doing this over 116 months. Why is it 116? Because over here, my months outstanding is not 120. My months outstanding is 4 months less because I issued the bond on May 1st. So right over here, I'm recording my premium or amortizing my premium on bond payable, crediting interest payable. When I go to pay the cash, when the payment is due, debiting interest payable for the 108, which is the 36 I accrued at the very beginning, plus the 72 I accrued over here, showing my total cash. Okay, so I find out that on April 1st or 3 months into it, I'm going to split up the bonds. So when I'm splitting up these bonds, what I do is I say, okay, what's redeemed and what's not being redeemed. So I redeemed 360. I didn't redeem 540. When you do this, make sure it adds up to the total amount of bonds payable. My premium amount over here, my total amount is 50,276. When I add up these two amounts, 50,276. So I've gone through and I've done that. Then what my next step is to do is to go through and accrue for. So for the redeemed bond, we've split this up between the two different T accounts. We basically want to make sure that it equals the total amount of our bond payable as well as our premium. Then for the bond that we're going through and redeeming, we're going to first figure out what that interest payment is. So right over here, we got our premium on bonds payable, or let's do the first part, the cash. So I'm buying back the bonds on April 1st. That means 3 months have passed. So for this bond, 360,000, interest rate is 12%, annual interest 43.2, 3 out of 12 months. So my cash paid for interest is 10.8. My premium on bonds payable is going to be 558.62, which is the 465.52, which is the monthly amortization, times the 40%, because we're dealing with 360,000 of the bonds, times 3 months. So the interest expense is a factor of that. And then we get in over here to the bond redemption. For the bond redemption, we want to make sure we're taking off this bond payable as well as the premium off of our books. Once we take this bond payable as well as the premium off of our books, we figure out how much cash we're going through and receiving 367,000 in cash because the bond was being bought back at 102. The gain on the redemption of the bond payable is therefore going to be the difference, or 12,352, to basically balance my journal entry. Over here on December 31st, 2021, I then have to deal with the accrual of the interest expense for my unredeemed bonds. So this is going to be 540,000 times 12%, but this is outstanding for the full year. So we're just going to go ahead and leave that as it may be. Then over here for the premium amortization, I'm going to take 465.52, basically times 60% times 12 months. So this is going to be 465.52 times 60% times 12 months. So this is outstanding from January through December. And then when we're dealing with straight line interest amortization or straight line amortization of the premium or discount, the remaining balance goes into interest expense. So I hope you enjoyed this presentation here today for problem 14-6. I look forward to seeing you on the next video. Have a great one.